love the channel and find it useful in becoming a happy retiree. Subscribe today. Now, we're talking about another tax break, or potential tax break, another tax break for some of you listening. Others, particularly those folks listening in California and Oregon and Minnesota, you're probably still fuming about the new Trump tax cuts, the new GOP tax plan. It helps everybody out on the federal tax side, or most taxpayers on the federal tax side for the vast majority of people in America. But it limits the state income tax deduction to $10,000. This is for a couple. Actually, it's not just the state income tax. It's actually called SALT. SALT is limited to $10,000. Now, SALT's the combination of state tax and local tax. So that means property tax as well. So if you're in a high income tax state like California or Oregon or Minnesota or Iowa, who would have known Iowa is a high tax state? New York, Vermont, those are some of the very highest tax states from an income tax perspective in America. Then you're still probably upset about having this major tax deduction that you had for years and years and years taken away from you. Quick refresher on this, and then we'll get to the tax help, at least for one state, for some of you listening, that was just passed, that's getting zero fanfare. Zero fanfare. You're probably just hearing about it right now. And that's why I wanted to bring it up here on the show, because it's a big deal and nobody's talking about it. Hypothetically, let's say, and this is the refresher, let's say you make $100,000 and you're married. Married, finally, jointly, and your state income tax, let's just say it's 5%. Let's use some round numbers here. That means that you'd pay about $5,000 in state income tax. And let's say your property taxes are another $4,000. So all in, your SALT, state and local income tax, is about $9,000. Well, you get to continue to use that full deduction under the new tax plan that started this year. If you want to, by the way, and it makes sense, if it makes sense on your taxes. Taxes are a very complex animal, and I speak about these in generalities because there's no way to know your exact tax situation. There's a lot of caveats to this, but I'm just giving you kind of a hypothetical. In most cases, this example works. However, if you make $100,000, same family, let's say, your state income tax is 9%. So now you're paying $9,000 in state income tax. So let's say your property tax is $9,000. Now what you've been doing for many years before this tax change is you've been using those together. $9,000 state income tax, $9,000 property tax. That's $18,000. The new tax bill now limits that deduction that has been $18,000 for many years for you to $10,000. So you lose $8,000 in federal tax deductions let's call it at a 30% rate. That's about $2,400. Now that's just one example. So naturally, the West Coast crew, and let's call it the New Jersey, New York crew, that population, no wonder that group of the country, that part of the country, does not like the new tax reform change, because those are high income tax states, high property taxes, and there's a higher percentage of that population that was used to taking these big deductions. But as another refresher, the other federal tax changes as a whole, for the vast majority of taxpayers, still results in lower overall taxes, or an overall tax reduction. Now, in some states, there was a sneaky problem that surfaced. One of the main reasons that the new GOP tax bill cut taxes for so many Americans is that it doubled the federal standard deduction. And we did the tax calculator right here on Money Matters. We had call after call after call. Hey, Wes, what are my taxes going to look like under the new tax plan? Well, you'd put in your state, what you were typically deducting in the past, and we'd give you a new tax number. But for the vast majority of callers, because the standard deduction is doubled, federal standard deduction, taxes went down or are still going down, or going to be lower for this tax year than they were in prior years. Again, that's great news for most folks. And naturally, many Americans are going to switch to using the higher standard deduction, which again is basically doubled. Now it stands at $24,000 for a family. But when you use the federal, and here's the problem that surfaced, when you use the federal standard deduction, in most states, you also have to use the state standard deduction. So remember, here in the state of Georgia, you do your federal taxes, then you do Georgia taxes. And in some states, like Georgia, Kentucky is another example, that has historically had an ultra-low standard deduction on the state level, let's call it thousands, if not hundreds and hundreds of thousands of taxpayers, were about to feel an added state tax pinch. So I had a bunch of AJC readers, and as I started writing about the tax reform, I had AJC readers, WSB radio listeners call me about this sneaky problem that nobody was talking about. So naturally, I looked into it. And I ended up with this small army of CPAs. And by the way, I'm not a CPA. I'm a certified financial planner, which again deals with investments and tax planning, but not actually doing tax returns. So I always go to CPAs, and I have a bunch of CPA compadres, if you will, to figure out these more complex tax situations. So I went a small army of CPAs. We're figuring this out exactly who in the state of Georgia, now that you're listening, was most likely to get hurt. And I called this group borderline itemizers. Wrote about it in the AJC. As these borderline itemizers, these are the folks that get most hurt by the new federal standard deduction because of how the state of Georgia works. And then we wrote about it. So I wrote an article in the AJC. It's called, the title of it, Georgia Taxpayers Must Do the Math Before Picking Deduction Path. That was the riveting title of it. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.